Last night was a brutal night in the stock market. The S&P 500 actually failed to hold the 6760 support, and for the whole day it was actually down towards the end of the market close, and we can see that it is about to test the Monday lows as well. And more than that, we are also seeing oil prices that have surged above $100 once again. And right now, we are in extreme fear territory. So today, I'm going to break down what actually drove the markets lower the past 24 hours, why are we seeing oil back up to $100, and what the charts are telling us about where the market might go next. We are in the third consecutive day of losses on the S&P 500, returning the gains that we saw on Monday. And at open, you can see that the S&P actually broke a key midterm support level at the 6750 area, and right now we are below that. We are at 6672, and it is possible that we might actually test the Monday lows first at 6634, roughly around this area right here. But if this fails to hold, we have to see how the market opens today. But if this fails to hold and we still see a lot more volatility happening because of the news happening around the world, expect to see actually test the 200 daily EMA roughly around here, about the 6600 area. And when we look at the Dow Jones, we are also seeing something a little bit concerning. Dow has actually closed below the 200 EMA for the first time actually since, looking back at the chart for the first time since May 2025. But you can see that this was the period of Liberation Day, and before that there was a lot of volatility here, so these technicals here is not exactly very viable to use as a reference. But the closest you can see is during after the Liberation Day thing was over, it actually closed below 200, but they recovered soon after. So but as of what we are looking now, it's hard to say whether will we continue to push back lower, or will this 200 EMA serve as a form of support. We haven't reached that Monday lows that we see, but it's possible that we might also test it as well. And when we look at the Nasdaq, this is on a slightly lighter note. Nasdaq actually also closed down 1.7%, similar to all the indices, but it is still holding that support area above the support area of 24400, partially because we did saw some small recovery across the tech sector that has been beaten down the past few months. You can see that even though the day before, S&P and Dow were actually red, but Nasdaq closed positive. So, but this also shows that we are not out of the woods yet. And this brings me to the main catalyst behind today's sell-off. More escalations are coming in. Iran has intensified attacks on commercial shippings. Now they have attacked oil tankers on Iraq as well. It actually caught fire in Iraqi waters, and this has caused Iraq to actually suspend operations at its oil port. Now, at the same time, we did also see neighboring countries. One of them is Oman, that is evacuating key oil ports as the war intensifies. So this is one of their key export hubs. And as we get more oil ports, any indication that supply is going to be tightened, oil ports closing, shipping routes being blocked, including this one, we see Iraq closing their oil terminus. These are all raising concerns about global oil supply. So everything is now headlines on how will it affect oil. Now, the situation escalated further after Iran's new supreme leader actually delivered his first televised address. So his speech was very defiant, and number one, he demanded that the Gulf nations close all US military bases in the region or face direct attacks. And actually, earlier in the day, Iran's deputy foreign minister did suggest that some vessels were being allowed to pass through the Strait of Hormuz, but in reality, those vessels appear to be Chinese tankers who has been purchasing Iranian oil. So the purchaser of Iranian oil, large bulk of it is from China. So it is not that the Strait of Hormuz is open, it is still closed. So the broader oil market remains effectively cut off from one of these most important supply routes. We see oil running up, pushing up to $100 right now. And interestingly, this happened despite this attempt by the International Energy Agency agreeing to release 400 million barrels of oil from strategic reserve. So even though this release is actually way larger than previously they released it during the Russia-Ukraine war. But the key issue here is that releasing this reserve does not solve the core problem, because the core problem right now is the Strait of Hormuz being that global shipping route. And until we see that shipping route being physically open, global oil supply will remain under pressure. Now, when we look at the technicals, you can see that there was actually a resistance area at 96, but this got breached easily. And as you know, right now, if we're talking about in today's context, technicals might not give us a full picture because everything is all headlines driven and macro driven right now. And right after that, the US Secretary of Energy acknowledged that the Navy is not yet ready to escort oil tankers through the Strait of Hormuz yet. And this is the same secretary that actually posted a tweet the day before saying that they have successfully escorted. So, and considering why this is not possible, it is especially because of the potential Iranian mines. Even though the US has said that they have removed some of it, they have already attacked some of the mine ships. But right now, this is a concern, right? That no one will want to cross over the Strait of Hormuz because if there was actually a mine, there was really mines there, and the mine go off, this will shock the entire global markets as well. And what he shared is that the earliest escort protections are not expected until the end of March. So that is about another 2 weeks later. So when you infer from that, what does it mean? It might mean that there is still 2 to 3 weeks more until the war resolve, or until longer. So for now, markets are facing the possibility that a major portion of global oil supply could remain disrupted for several more weeks. And that uncertainty is what actually pushed oil prices to touch $100 per barrel. Now, interestingly, when we look at some positioning data, this suggests that the market, there are actually some bearish bets that are actually building. So this is the short exposure in US macro products, both index and ETF by Goldman Sachs. As you can see that the short positions in US equity have reached the highest level since September 2022, roughly right around this area around here. Right? This means that the market is becoming increasingly crowded on the downside. It means that more people are shorting the market now, are thinking that the markets will continue to push down. And when positioning like this becomes one-sided, so it can sometimes create the conditions for a sharp short squeeze. So in simple terms, what does this mean? If we have a single positive headline, for example, a comment from the White House or a comment from the Iranian regime, that there's progress between both parties, saying that there is good talks between reopening the Straits of Hormuz. This could trigger a sudden rebound, which means a very, very strong rally in equities. And at the same time, investors and the markets, they are all looking ahead to the Federal Reserve meeting that is scheduled for next week. And right now, you can see that markets are assigning a 99.8% chance that Feds will keep the interest rate unchanged. So this is kind of already a guarantee. So the main focus will not be on this rate cut. The main focus will be on how Jerome Powell, the current Fed chair, talks about the data that just came out, the CPI data, the unemployment rate, and what he thinks for the next Federal Reserve meeting that's going to happen in April. And if Powell comes out and strikes a more hawkish tone, this is where we might see Treasury yields move higher in a bid to run to safe haven, and it will actually put additional pressure on stocks as well. And there is also another factor complicating the outlook. Now, this is a tweet that just came out a few hours ago. Trump is asking Federal Power to actually drop the interest rates and not the next meeting immediately, right? And this comes on the backdrop that oil prices is increasing, which implies that inflation rate will be increasing. And with him asking for Powell to drop interest rate, it is a bit confusing, right? Is he trying to get inflation to another level, because by decreasing interest rates, you are potentially making things cheaper for companies to purchase, making consumers be able to spend more, which might push inflation rate higher already. Now, there is a caveat here, which is Powell is expected to step down in May. And right now, another successor will come in, and this will be selected by the Trump administration. Right now, it's this guy called Kevin Walsh. But this transition could actually introduce new pressure on future rate decisions. Well, interestingly, while we saw equity sold off sharply, the cryptocurrency market actually remains relatively stable. So you can see Bitcoin actually did pretty well over the past few days. So even though it's been deemed as a risk-on asset, but as how it has been moving the past few days, as stocks were going down, Bitcoin was actually going up, and you can see it has now pushed back above the $70,000 region, and the first level of support that it will be testing is of course this 72,800 area, the 50 EMA line, whether it can break above or not. We did also see some development coming from MicroStrategy, which is a Bitcoin treasury. They actually purchased another 18,000 worth of Bitcoin, that is total worth of $1.3 billion. So despite the broader risk-off environment that we see, it's pretty interesting how crypto markets have so far remained relatively resilient. Even though for it to have more sustained momentum, we do want to see Bitcoin breaking past this $73,000 area. Now, moving towards companies' earnings that released yesterday, any companies update, the biggest one actually came from Adobe, who did actually beat their Q1 estimates. As we know that Adobe has been beaten down over the past few months because the concern is whether AI will actually replace their whole business. And over the past few quarters, there hasn't been very clear signs, even though their numbers have been improving, that their business will not be replaced by AI. So, and actually, when they released their earnings result yesterday, they delivered actually record quarterly cash flow and also beat expectation on both results and guidance. But the stock still fell after hours. It was down about close to 8% after hours. And the main reason wasn't that they beat the earnings, they had great guidance. There were two main reasons. The first reason was that the investors were not convinced that AI will still take over the business, right? Investors were convinced that they will still be impacted hard from there. And another big one is the CEO, the longtime CEO, announced that he will step down after 18 years of leading the company. So leadership uncertainty ends up overshadowing otherwise a very, very strong result from Adobe. Now, here's what I think about the markets today. So in my opinion, with the indices now testing the support and specifically looking at the S&P, it has actually broken below that support. Today's market open will be a deciding factor heading into next week, right? We will have to see this support holding or recovering back up for the S&P. Of course, barring another new wave of hostility from both US and Iran about not stepping back from the war. In fact, we are seeing news about how the US has actually spent over $10 billion even over these few days of war. And as long as we see the Strait of Hormuz remain disrupted, oil prices are likely to stay volatile. And as oil prices stay volatile, as the volatility index will continue to be elevated and stocks will continue remaining under pressure. And it will spill over to other inflation expectations as well as in bonds and other asset class. And for now, markets are essentially waiting for one thing, which is full clarity, right, on whether this geopolitical shock will escalate further or begin to stabilize. It's hard to say from now, but one thing is for sure, right, based on what we saw from the data from Goldman Sachs, right, if you just need one positive headline, as we did saw on Monday, right, Monday was a little bit of insight into what might have happened if one positive insight comes in, is we will see that rally comes back, right? So I would say that now is a time where you don't want to be too overly cautious. At the same time, you do also want to watch because the situation is still developing bit by bit. Because the next move of how we see the market might move, especially in oil, will determine how the market will move next week as well. So that's all I have for you for today's video. If you do enjoy such content, be sure to hit that like and subscribe button. It would really help me to create more of such content for you. So thank you, and I'll see you in the next one.